Welcome back. It's time now to take a look at the top business stories. Moody's upgrades outlook on DP World. Preliminary agreement signed in Etisalat Zain deal. And we find out how recruitment agencies are promoting Dubai off the back of the crisis. Most of the GCC markets ended lower this Wednesday, and the UAE bourses also continue to fall. Asian markets ended mostly high as investors await the outcome of the US Federal Reserve meeting today. The DFM fell 0.5% to close at 1,735 points. DP World gained 1.5%. MR Properties lost 0.5%, while Arabtech fell 1%. Do continue to fall. The telecom operators' shares were down 1.5%. 159 million shares were traded, valued at 177 million dirhams. The ADX fell marginally to close at 2,761 points. Aldar Properties continues to fall. The company's shares were down 1.25%. Abu Dhabi Commercial Bank was also down 0.5%. 117 million shares were traded, valued at 208 million dirhams. Moody's has changed its outlook rating on DP World from stable to positive and affirms its Ba1 rating of the company's Sukuk. Analysts believe the decision is optimistic for the company as it's due to be listed on the London Stock Exchange in the future. However, with the recent volatility seen in global stock markets, they feel the decision may only result in a limited amount of investor confidence.
This reflects a pickup in global trade in the first half of the year. But of course, what you have to ask is this going to be sustained through the rest of the year? And the signs certainly are from Singapore that trade has turned down in the third quarter. So Moody's is catching up with events. But of course it's a positive thing for DP World and good for their potential to list next March in London. This sort of move does add confidence, but over the last couple of days we've seen the markets come off quite strongly, and they may now be anticipating a further downturn in US financial markets. They could be at a peak now.
A preliminary agreement has been signed by shareholders in Zain to sell 46% of the phone operator's shares to Etisalat. In September, Etisalat bid for a stake in Kuwait's largest phone operator for an estimated $12 billion. Zain's majority shareholder Karafi Group and Etisalat today signed an agreement to start the due diligence. The deal, upon completion, will give Etisalat majority control of Zain. Now, as currencies in emerging economies continue to appreciate, so do concerns of a global currency war. So will the conflict continue, and what are the possible consequences? To discuss this further, we're joined today by Philippe Douwer-Pantenons, Senior Economist for the Middle East and North Africa at Standard Chartered Bank. Welcome to the show again, Philippe.
Thank you for having me.
So how much of a threat are the potential currency wars to global economic recovery, considering that the US is struggling to recover?
Well, certainly today there is a temptation by many countries to use currency as a policy tool. Now, the problem with that is that when you devaluate your currency, it's always against someone else. So generally it can trigger a chain of destabilization. Now, in terms of the US dollar, precisely, we have seen the US dollar falling quite drastically in the recent month. But we think that the dollar room to fall more is very narrow. We think that the market has priced in the quantitative easing that has been announced, that the package will be smaller. And finally, we think that there is a floor to how much the US dollar can go, because you will always have major purchases of US assets.
So going forward, what kind of impact could this have on the region's economies?
Well, in fact, for the dollar, which is obviously the most important currency in the region, We do see it stabilizing at around 140 by the end of the year, and actually we see the dollar picking up slightly at the beginning of next year as the recovery in the US economy will start to hit the news. So I think that we can say that we are in familiar territories in terms of the euro-dollar cross-currency, and hence the level of the dollar for the region. The main threat to the region when the dollar weakens is obviously imported inflation, mainly through food. But the difference now, instead of 2 years back when the dollar weakened again, is that today inflation is very low in all the GCC countries except maybe Saudi Arabia. So we are not in a major risk of imported inflation pushing the headline inflation too much. So we don't see a major destabilization from that.
Thanks for your time, as always, Philippe. See you next time.
Thank you for having me.
Most of the GCC markets closed in negative territory today. Let's check in on those numbers now, starting off with the UAE general indexes. Coming up now, let's take a look at the major international currencies against the dirham, followed by the price of oil and the precious metals. On the way after the break, we talked to Christo Daniels, the Managing Director of Morgan McKinley UAE, about the challenges that recruitment agencies face in promoting Dubai as a serious financial destination.